told you it takes about 10 seconds. Shouldn't actually put that up. Here we go.
Okay, good afternoon, everybody. My name's Kim Reynolds and I've got Brett Griffiths with me. Today we're going to be going through a little bit of what the federal budget was about last night. So looking at what's behind the doors from the release last night. So if you need to contact Brett or I after the session, if you've got any particular questions, then our contact details are here. Feel free to give us a call or shoot us an email if you get a chance. So I guess before we start really looking at why we're here today, we're trying to essentially understand the aspects of the budget that are going to impact on you and your businesses. We'll do that by looking at how we can pull apart what was announced last night and then hopefully translate them for you to the extent that we can, given the level of detail or lack of detail that we have at this stage on a lot of items. And so at the end of the session, hopefully you'll have the highlights of the budget that will allow you to plan for 30 June and hopefully beyond. So let's check out what's behind the doors.
As with any budget, you're always going to essentially have winners, the in-betweens and the losers. So we've had a look at the measures that they've proposed in the budget, and this is sort of our list of what we've come up with. So essentially, the winners, we believe, are the school kids through the education promises with Gonski Mark II, the NDIS, older Australians. Sydney has done very well on the infrastructure side of things. Patients, farmers, Western Australia not so well on the infrastructure. Traditional broadcasters, first home buyers, the pharmaceutical industry and national security. The in-betweens, really defence and small business. There's not a great deal that we didn't already know about in that. And as far as the losers go, well, taxpayers in general, big banks, you've probably heard about their little new tax. University students, foreigners particularly, welfare recipients, smokers, the anti-vaxxers, so those who don't believe in vaccination for their children, those in superannuation and foreign aid.
Okay, so before we get on to the first topic of housing affordability, I guess it's important to think about, we look for the budget each year for tax reform and announcements in relation to meaningful tax reform. There never seems to be a right time for that reform. I think given the current makeup of Parliament over recent years and currently, it's a difficult task to undertake because the tax system is not getting any simpler, and so therefore it's more difficult to sort out and actually essentially start from scratch. So it tends to be put in the too hard basket for, like I said, meaningful tax reform. So last night's budget was another demonstration of that, where there are some tinkering around the edges of some items. We've heard some comments from the Treasurer in recent weeks as to let us know, ease us into what was going to be happening. So, and housing affordability has been high on that agenda. One of the items that has been talked about since last night was in relation to the rental property travel expenses. So from the 1st of July 2017, travel expenses that relate to inspecting, maintaining and collecting rent from residential rental properties, so it's important to know that it's residential, not commercial, there won't be a tax deduction available to taxpayers in relation to those. So this is, I guess, a sly way of starting to chip away at the negative gearing side of things, and also an integrity measure, because the government has seen that a number of taxpayers have been claiming travel deductions without correctly apportioning those expenses, or have claimed those costs where they are really related to sort of private travel purposes. So it's a measure that will alleviate some of that pressure. So it will be disallowed, those expenses will be disallowed from the 1st of July 17.
And Kim, that is only residential property, isn't it? So if you have a commercial property, then you still can.
Then you're still okay.
Yeah.
Exactly right.
As part of the housing affordability measures that were announced in the budget, there's a couple of measures that they're really trying to utilise superannuation to help with. And one of those is basically allowing a mechanism whereby older Australians can downsize their home and put that money into superannuation. So essentially, those that are over 65 and have held their house for more than 10 years can actually make a one-off contribution to superannuation of $300,000. Now that's a per person or an each thing, so a couple means 600,000. Now, what's interesting about this is that for those of you who are aware of this thing that we have called the work test, normally, once you're over 65, you have to work for 40 hours and 30 consecutive days to be eligible to put contributions into super. What the budget papers referred to last night, and obviously we don't have any detail around it, but what the budget papers referred to is essentially that notion being ignored. So in other words, it doesn't matter how old you are, so long as you're over 65 and you've held the family home for more than 10 years, you're eligible to contribute up to $300,000 per person. And that also ignores, or we're allowed to ignore, the new change that's coming from 1 July 17, which is the $1.6 million limit, where once you have more than 1.6 million in super, you're not eligible to contribute further non-concessional contributions into super. So they're actually making an exception to laws that have been around for a very long time, and also laws that we don't even have in place yet.
So on that downsizing of the home, was there anything announced last night that actually could monitor the fact that you are actually downsizing, or is it just an all-encompassing term for changing residence after you're changing your home after you're 65?
I actually have no idea how they're going to be able to track this logistically, for the simple fact that normally when a contribution is made to super, the superannuation fund has to verify that the age of the member and if they meet certain work requirements. Now, that's well and good for the super fund to do that, but then that has to translate to a reporting mechanism for the government, because as part of the new measures coming from 1 July, the ATO are going to be doing lots of data matching and saying, well, they're over 1.6, so therefore they can't contribute anymore, and we're going to issue them an excessive contributions notice. So there's going to have to be a new mechanism built in the next 12 months, potentially labelled on a tax return for self-managed fund, that will actually have another label that will say, yes, this is because of this measure. And then it's going to be the trustees are going to have to say, is this contribution that you've made because you've sold your home? So basically it's going to come back to the member signing a stat dec and pushing that through to the tax office, and then presumably the tax office may do some data matching through title records and the like to verify that. So I think there's a lot of honesty built around this at the moment.
Okay, the devil's in the detail.
Always is.
Okay, so the third item in relation to housing affordability relates to the area of rental properties again, and interestingly, it was something that we didn't really anticipate or expect last night, but from the 1st of July 17, the government is going to limit the extent of plant and equipment depreciation deductions that can be incurred by or claimed by investors in residential real estate properties. So as I'm sure many of you know, that if you buy a property for rental purposes, then one of the suggestions from your advisor or the real estate agent might be to get a quantity surveyor's report, so that would allow you to determine what depreciable assets versus capital works deductions you might have, and a claim is made each year in relation to those based on those reports. This new proposal is basically saying that plant and equipment items that are usually mechanical type fixtures, or those that can be easily removed from the property, will fall foul of this rule, and in order to make a claim for those deductions, the investor will need to actually directly incur the expense. So if I buy a property and from Brett's already put the dishwasher and ceiling fans and all those things in place, and as part of my purchase price, those things come along with it. Then I get a quantity surveyor's report. It also takes into account that I've got those items in the property, and I make a claim under the current rules for a deduction each year in relation to those. These new rules are basically saying that as I haven't directly incurred the expense in relation to the dishwasher or ceiling fans, then I don't get to make the claim, because essentially it's incorporated into the cost base of the asset that I've acquired. So I imagine there'll be a number of quantity surveyors out there that'll be having a think about what this really means to their business models going forward. It's important to know that these measures are from the 1st of July 17. So, and existing investments have been grandfathered, so they're prospective. If you've got a contract in relation to a property that was entered into prior to last night, then you're okay. But contracts entered into after last night are going to be, impacted by this change.
Kim, we were actually talking about this last night, about how quantity surveyors might not actually be too happy with this proposal. But I was thinking about it this morning, and I actually don't know if it'll make that much difference, because why don't be the quantity surveyor will probably still do the same report, but it will put more onus back onto us as to what we can and can't claim. So we'll have to essentially go through their report and cherry pick it more.
Well, I guess most quantity surveyor reports, the ones that I see, have a table. Essentially, these are the capital works allowances, so your 2.5%, and a depreciable items, expense or allowance that gets claimed each year. So that column essentially in the table would be ignored for all intents and purposes, and we'd be looking at the actual expenses incurred by the investor each year. So there might be an opportunity or consideration of purchasers when they're purchasing properties, that they actually separately identify the assets themselves, so that it doesn't form part of the cost base. There's a bit of water to go under the bridge yet. It's just a few lines in the budget from last night. So the devil is in the detail, and so that we'll see what actually comes of it.
Now, as with all things super, whatever old becomes new again. The next housing affordability measure that was announced last night is essentially a rehash of what a Labor government brought in back in 2008. The first, they call it the first homeowners savings grant, where you could put money into a superannuation fund and then access that. Because it had such a low take-up, essentially they got rid of it. So that was removed, I think, 2013. So we now have this measure being reintroduced, a little bit different. So what they're saying now is that you can salary sacrifice up to $15,000 to superannuation, and with a total of $30,000 over per person. So presumably a minimum of 2 years, but presumably a bit longer. Plus the associated earnings can be withdrawn from super to then use as a deposit to buy a house. It's quite interesting how they've done it, though, is they're actually saying that withdrawal is a tax at the individual's marginal tax rate less a 30% tax offset. So they're essentially saying that we're assuming that there's 30% tax paid on this withdrawal, but we're just putting in your assessable income. So if you're earning less than an average tax rate of 30%, then the reality is that you will pay no tax. If you're earning more than an average tax rate of 30%, then you will pay a bit more tax on that withdrawal. From a practical point of view, this is going to be really tricky, because within superannuation, one member of a super fund can only have one accumulation account. You can have multiple pension accounts, but only one super account. So they're almost going to have to come up with another way to capture this, another member account inside the super fund, assuming that the member's super fund actually allows them to do this particular savings deposit. So then they can keep track of that capital as well as the earnings associated with it. So that's going to be interesting how that actually works from a practicality point of view. Once again, I suspect that it'll have a low take-up. However, maybe the people, particularly in Sydney and Melbourne, it may be of more relevance to them now than what it has been previously. So that'll be interesting to see how that one plays out.
Okay. So in relation to, again, on the theme of affordable housing, the CGT discount has been amended or will be amended as part of this proposal. And from the 1st of January 2018, where housing is provided to low to moderate income tenants and the rent that's charged to them is at a discounted rate to what the market says, then the CGT discount for individuals that own the property, so on sale of that property, will increase from 50 to 60%. So it's something that's being put in place to sort of encourage individuals, people like you and I, to invest in the rental market, but make those properties available to the low and moderate income earners so that they can have a roof over their head. There are some eligibility criteria, I guess, for the types of rental that is provided. So tenant eligibility is going to be based on their household income thresholds and the composition of the household. So I guess that means that there's families living there as opposed to it being a general share house or something along those lines. And the property needs to be managed through a registered community housing provider. And also critically, the investment needs to be held by the investor for a minimum of 3 years. So it's an effort to encourage us to invest in affordable housing. The mechanics of how that's going to be done and the red tape and bureaucracy that I guess goes around making sure that the tenants are eligible and with the registered community housing provider, etc. I think that will cause some teething issues along the way, but it's a worthwhile effort anyway to see how it pans out.
It seems like there's a few trips in there that could easily catch the owner out if your tenant, for argument's sake, happens to get a new job that then pays the more they get them over at that particular income threshold.
Yes, I think you're right, and I think that it's something that when I said at the outset that that our tax system's definitely not simple, there's a need more and more for taxpayers to actually get assistance in preparing their tax returns. So there'll be a lot more onus on us as advisors, I think, to be looking at those issues and asking those questions when we're preparing returns each year to ensure that the conditions and eligibility requirements are still being met.
Yeah, you're almost going to have to do an audit of the tenant.
Almost, yes. Yeah, I imagine that there will be some sort of reporting requirements in the returns that'll have to be covered off on. Those individual tax returns are getting bigger and bigger each year, so I expect it'll be something that'll be incorporated in there. Okay, the other item in relation to housing affordability is capital gains tax and foreign and temporary residents. So this measure is seeking to deny foreign and temporary tax residents from accessing the CGT main residence exemption, and that's effective from last night. Existing holdings of property, though, are grandfathered until the 30th of June 2019. So again, it's probably not a measure that's going to impact on a lot of people, but it is a further eroding of the eligibility for CGT concessions by foreign and temporary residents in Australia. So again, something to, if you've got any foreign residents or temporary residents that you look after, need to be asking more questions about their actual home that they're living in, as opposed to just assuming that it's a main residence and yes, it's all good. There's no tax.
Kim, do you think that's more of a political measure rather than an actual affordability measure?
I think there's an element of that. You know, it's making sure that the government is seen to be catering to to Australians, you know, people that are here on the ground all the time, as opposed to people that want to necessarily invest in the country, in the residential market particularly, given the pressure that it's under. Okay, so the next item in relation to housing impacts on the foreign resident CGT withholding. So you'll remember last year that there was the CGT withholding was introduced for the disposal of residential property in Australia. So essentially, where we dispose of a property, we need to apply for an exemption certificate if we're a resident, or alternatively, the purchaser needs to pay an amount to the ATO on settlement in respect of the withholding that's required. That withholding rate, when the legislation was introduced, was 10%, and the threshold level over which you needed to report and get an exemption certificate was relating to properties that were over $2 million. In the 12 months since the legislation was introduced, the government has had a bit of a rethink, apparently, and so from the 1st of July 17, so in a few weeks' time, the CGT withholding rate is going to increase from 10% to 12.5%. And also, interestingly, the threshold above which this reporting and these exemption certificates is required, and payment if you're a foreign resident, is required, has been reduced from $2 million down to $750,000. So if you think about the housing market at the moment, that is going to cover quite a lot of home transfers, you know, residential property transfers that happen in the market from here on, you know, essentially from the 1st of July. So what that means is that if you're selling property, value of the contract's more than $750,000, if you're a resident, you need to apply for an exemption certificate so that can be provided to the purchaser and they don't withhold 12.5% from the purchase price before giving it to you on settlement. It's an interesting change, I think, particularly the reduction in the threshold, because we all know that the government, the tax office, does a lot of data matching with the state revenue authorities, and it obtains the data of where the property transfers, you know, that happen day to day, but the time frame of when they get that information, there's a bit of a lag, so they have to ask each of the state departments to give that to them, and then they match it with the records that they have. So that takes a little bit of time. Whereas changing the threshold for the CGT withholding to $750,000, it essentially means that they're getting real-time reporting for the transfers of properties over $750,000, and the reporting is happening to them, to the tax office directly. So it makes it easier for them to see where there are property transfers, and then to match them with returns, and data collected from other places on a more timely basis, and follow them up on a more timely basis. All those lovely letters that we get, you know, just letting you know that your client has disposed of a property located at, you know, XYZ during the year. Just checking that you're going to disclose it in the return, or that you were aware of the transfer. So if you need to disclose it in the return, then you do. So we may see a few more of those sort of letters coming through in the future.
Well, what's actually interesting, Kim, is the seller applies for the certificate before they sell. So the tax office actually find out when the owner is looking to sell the property before they actually sell the property. So it's even before real-time data.
That's right, yeah. So normally we would get a certificate or apply for a certificate at when a contract is signed, but in some circumstances we'll apply for them beforehand. So as you said, when somebody's actually thinking of selling, so yeah, they'll have the data beforehand and know what's going on.
And that 1 July 17 commencement date, that is, do you know if that's contract date or a settlement date, or we don't know yet?
I don't know that yet.
Yeah.
Somebody might, but I don't at the moment. Yeah, I would expect that it's contract to date.
Because I was just
don't
thinking,
hold me on that.
No, because I was just thinking that it wouldn't be unfeasible for contracts to be entered into around now that might not settle until after July.
Exactly right. Yeah. Well, I'll check that out, and I'll post something on our webpage, and so people can see what the answer to that is. The other item in relation to foreign ownership relates to foreign ownership restrictions where there's a development of a property, and the foreign ownership of those new developments will be capped at 50%. There'll be a condition required to be satisfied with the issue of what they call new dwelling exemption certificates. So this is going to impact on property developers, and it'll be part of the pre-approval relating to the development itself. Again, something that was announced last night that I'm not sure that we really heard a lot of talk about, but the cap will be included as a condition in new dwelling exemption certificates where the application's made from today onwards. And just in relation to developers again, on the managed investment trusts are going to be able to invest in affordable housing, and which will allow investors to get some concessional tax treatment. So there may be a change in the way that property developers structure their development activities as a result of this. But managed investment trusts they're a specific type of animal for tax purposes. So there'll be a little bit of thought, I guess, employed to work out what the best options might be from a structuring perspective to get the benefits of that and be able to pass those on to the investors and individuals. There's also a change in the principal asset test, which really relates to areas where we've got taxable Australian property. And there's a provision that basically says if you have taxable Australian property, Australia will have taxing rights on it, and you'll be required to pay tax on whatever that asset is if you sell it. From a CGT perspective, you can indirectly own Australian real property, and the principal asset test that currently exists in the legislation doesn't clearly relate to an associate inclusive basis. So the legislation is being amended effective last night to ensure that foreign residents can't avoid the CGT liability by essentially disaggregating their indirect interests in real property. Foreign-owned residential property. Now, this will be an interesting one, I think, for the government to actually monitor and manage, but the government's going to introduce a charge on foreign owners of residential property where they don't where the property isn't occupied or genuinely available on the rental market for at least 6 months in the year. And that charge is going to be levied on an annual basis. And essentially it's going to be applied to encourage foreign owners of residential property to make the properties available for rent where they're not using them as their home, and to increase the number of dwellings that are actually available for Australians to live in. It is a measure that's going to be administered by the tax office, and it applies as of last night. It's supposed to provide a gain to the budget of $16.3 million over the next 4 years or so. Possibly not a huge amount in the context of the entire government, and I think it'll be a reporting nightmare. But again, as I said earlier, the reporting on tax returns is becoming more and more important, and this will be another item that'll be included in there somewhere.
I'd love to know how they're actually going to monitor that and to keep track of it. And also, I find it fascinating how they can actually assign a dollar value to it over the forward estimates.
Yeah, yes. Yeah, it will be a challenge, I think. Yeah.
This infographic here we thought was a really good way to summarise essentially what the government is looking at in this budget as part of their housing affordability. So essentially, there are many facets that they're looking at. So that includes unlocking land, which the Commonwealth can only control so much. So the Commonwealth has already announced last night that there is certain land in Melbourne, 10 k's from the city, I believe, defence surplus land that they're no longer using, and also there's some land in Sydney, I think, is in a similar sort of boat that they can release. But most of the land, because of the Constitution, is actually controlled by state governments. So they're the ones that really have to look to unlock land to allow developers to then essentially undertake developments. So we have the housing that can be built. So there's only certain levers the federal government can pull, and obviously, as we've just discussed, they're pulling a few of those, albeit gently. So there are a number of different things that are really at play when we're talking about the housing affordability crisis as it's been defined. So really the infographic helps sort of explain all those different machinations, but also how they all interrelate with each other, which I think is really important because it isn't a silver bullet approach that can be applied or that is being applied, but rather it's there are many levers that need to be pulled, not only by federal government, but also by state and councils. So I think this will be an ongoing challenge of particularly New South Wales and Victoria for Sydney and Melbourne. But even here in Brisbane, we're seeing that prices are certainly, the median house price is certainly increasing. I think it's up to around $540,000 now. Granted, Sydney's over 1.1 million, so it's a different kettle of fish altogether.
I was reading the other day that I think there were 78 suburbs in Sydney that had a median house price of over $2 million. So
that's insane.
Yeah, so hence why housing affordability is a pillar of last night's budget, I think.
Yeah, and it's something they have to do very carefully because if they pull the lever too hard, then it might help the Sydney market, but then it could cause huge adverse effects for the rest of the country. So yeah, it's a real tough one for a federal government to handle alone.
Yes, yeah, because it does depend on negotiating with the state governments as well, and when you've got a mixture of the makeup of those governments between coalition and Labor, it makes it a little challenging.
Yeah, well, we've seen that with education and health in the last few years.
Exactly right. So. Yeah. Okay, so the other item that I wanted to chat about in relation to small business, there wasn't a lot on the agenda last night for small business. As we said at the outset, it was one of those neutral areas. But two items that were announced or discussed were, one was the instant asset write-off. That was due to finish on the 30th of June this year. That's now been extended till the 30th of June 2018, so another 12 months. And it basically allows an instant asset write-off of up to $20,000 for small business entities. So that's good news for small businesses. It's just a matter of how they utilise it over the next 12 months. I'm not quite sure how much longer they will extend it. If they, I guess they're not going to keep extending it, but take advantage of it while it's there, I think. The other item in relation to the small business sector was the small business CGT concessions. Now, as we'll talk about a little bit later, the small business CGT concessions are not subject to the increases in the definition of what a small business entity is for other purposes, so tax rates, etc. So a small business entity talks about having a turnover of $2 million and net assets of $6 million. Those small business concessions are going to be tightened so that they can only be accessed in relation to assets that are actually used in the small business or an ownership in a small business. Now, there have been some structuring opportunities, in the past where taxpayers have been able to access the concessions, for assets that are actually unrelated to their small business. So, an example is arranging their affairs so that ownership interests in larger businesses don't count towards the tests for eligibility. As you know, that it's only when you hold more than 40% in a company, for example, that whole entity is included as a connected entity. When it's less than a 40% ownership, then you only include the percentage ownership that you hold. So there are some ways to play around with that. This proposal is to, I guess, quash a lot of the trickiness that was building into the concessions. It is an area, the concessions generally is an area that there is a lot of audit activity on. And this, I think, is just another example of the importance of treating these concessions not just as a calculation that you do when you prepare the tax return at the end of the year, or to think about at the time when you're doing the tax return at the end of the year, but think about it proactively and really ensuring that the taxpayer is eligible for those concessions, because they were difficult enough at the outset, but they're progressively becoming harder and harder to actually apply, particularly as businesses become a little bit more complex, small businesses become more complex, and with their structuring as well as just their activities, trying to make sure that all of those boxes are ticked can be a challenge. So better off doing it proactively than assuming that you're going to get it. The last thing that you want is for the tax office to ask you a question when all you've got is a calculation on the page and no real reasoning as to the basis on which the concessions are available.
And the thing to remember with that too, Kim, is that rolling forward with the super changes that are happening from 1 July, the small business CGT concessions, if they're looking to roll that into super, they're actually exempt from the $1.6 million non-concessional contributions cap limit, if you like. And also they sit outside the $300,000 non-concessional cap. So it also then comes to thinking about how the inflows of money into super are really important and how they're defined when they're on the way in. Because if you use the CGT small business rollover relief first, and then you try and make a non-concessional contribution, you may actually not be able to make the non-concessional contribution because you're over your 1.6 million. So having that pre-thought and that the dialogue around what to do first and what essentially is triggered first is really important.
And also, I guess, going into having those that $1.6 million pension cap as well, all of those things come into play. It's not just a matter of I've sold an asset and I can apply the small business concessions and done and dusted and everything's sweet, because it does have a flow-on effect to other things down the track.
Oh, it certainly does.
And those caps could be quite hit you quite harshly down the track.
Oh, look, I suppose the structuring and the planning that goes into arrangements now is a lot more than what it was 12 months ago.
Yeah. Keeps us on our toes. That's what it does.
That it does.
Okay, so in relation to individuals, there are a few things that were announced last night, or not announced, I guess. The debt levy wasn't really mentioned. The debt levy was actually proposed to end on the 30th of June 17, and that is the case, so it won't extend past the 30th of June 17. So that essentially means that individuals in the top marginal tax bracket, so earning over $180,000, will get a 2% tax cut, essentially, as a result of this levy not being extended past the 30th of June. The other interesting point was that the Medicare levy is going to increase to 2.5%, but it's going to increase from 2.5% on the 1st of July 2019. So we've got a reduction in tax for high income earners effective from the 1st of July, and then in 2 years' time, everybody will be, apart from those that are subject to the low income thresholds, will have an increased Medicare levy of an additional 0.5%. So the purpose of that 0.5% increase is to fund the NDIS, there's been a lot of media attention in recent months, probably over a couple of years really, about the funding of the NDIS and how that's going to really happen. And this increase in the levy is to assist with that process. Now, other tax rates that are linked to the top marginal tax rate, such as the FBT rate, will also be increased as part of this increase in the levy. But like I said, that's not until 1 July 19.
It's actually surprising they pushed it out that far. I thought, particularly for the high income earners, they might have had a scaled approach where they brought it in earlier, because essentially they're already used to paying the debt levy, so why not just almost continue that on? And
as some people were saying last night in the commentary post-budget, was that essentially high income earners are getting a 1.5% tax reduction because of the increase in the levy and the taking away of the debt levy. So I guess we'll see how that plays out politically, and but it is what it is at the moment. So. As I said, the Medicare Levy low income thresholds are going to increase. This normally happens each budget, so there'll be a slight increase for singles and for couples, and there's nothing really new on that side of things. The last major point I wanted to comment on here was in relation to help repayment thresholds and faster repayments. So essentially a new set of repayment thresholds is being introduced, and the implication of that is going to be that the minimum repayment threshold from the 1st of July 18 will reduce down to $42,000, and it'll have a lower repayment rate, a lower 1% repayment rate, and there'll be a maximum threshold of almost $120,000 with a repayment rate of 10%. So this was talked about in the last couple of weeks by the Education Minister, and something that has caused a bit of concern from the students' perspective. It's all part of an overall package in relation to tertiary education, so the change in the funding mix, etc., for higher education, and getting students to contribute more to their education as opposed to the government footing the bill.
It's actually interesting. My eldest daughter's at university this year, and she talks about the student union bodies and trying to have her sign petitions and get her involved in protesting around this sort of measure, which I find it a little bit ironic, because they are investing in their own education and hopefully in allowing them to get a better job in the future.
Yeah, and I don't know if they see it like that when
I'm sure they don't.
Coming out of their pocket, but yes. Yeah. I guess one important thing to note also in relation to that help stuff, something that was raised with me the other day, was that from the 1st of January next year, subsidies for most Australian permanent residents and most New Zealand citizens that are enrolling in, for Commonwealth supported places is going to be withdrawn. So that will make those particular students fee-paying students. So that's something to keep in mind if you're aware of any permanent residents or New Zealand residents. Just quickly in relation to the family tax benefit, Part A payments. So from the 1st of July 17, the supplement payments are going to be reduced by $28 a fortnight for each child that doesn't meet government immunisation requirements. So that goes towards Brett's comment at the outset about the anti-vaxxers bandwagon. That so that those payments will be subject to those issues. I've put this on here, this no standard tax deduction for work expenses, mainly because there's been a lot of talk over the last few years about introducing a standard deduction for work expenses. It's an area where the government does have, the tax office has a lot of trouble trying to get a handle on what are real work-related expenses and what might be slightly inflated. And this standard deduction for everybody has been talked about. It seems that it's too hard because, again, it hasn't been introduced this year. So the budget was silent on the proposal. So again, I'm sure it'll rear its head again down the track, but at the moment it's on the back burner for everybody.
It's interesting you say it's too hard because, excuse me, don't they do it in New Zealand?
I think so, yeah. So, and there's a number of countries that have something along those lines, but we like to do things differently here.
We like to make it harder, don't we?
That's right. Yes. So some of the other measures that were announced last night relate to the foreign investment framework. So really that's just looking at clarifying and simplifying, I think were the words that we used last night, to reduce the red tape and simplify the fee framework for foreign investment. That's something that is not necessarily a tax issue, but if you've got people that are looking to invest from overseas, then something that will need to be considered.
The banking levy, Kim, I find quite interesting, where they're looking to impose a levy of 0.06% on the big five banks. So essentially that's ANZ, NAB, Westpac and Commonwealth, as well as Macquarie. Now, while it seems like a fairly low number, it actually equates to a $6 billion tax.
Now, over the next 4 years.
Over the next 4 years, sorry, yes, over the forward estimates. And I think you were saying earlier that that's paid quarterly.
Yes, that's my understanding, that it is supposed to be mandated on a quarterly reporting basis.
And in the speech last night, the Treasurer did make reference to how they're trying to do it on an institutional basis, so that way it won't be something that can be passed on to consumers, which I find a bit of a furphy, because at the end of the day, the banks make money, and either they do that through interest or fees, essentially, as well as other activities, but primarily, and those profits are either absorbed in part of their running expenses or they're passed on to shareholders. So if they want to keep their shareholders receiving the same amount of dividend, then they're going to have to create another fee or increase the fee, increase interest rates somewhere to create an equilibrium of income and expenses.
That's correct. Yeah.
So I either think that it will affect the retail investor, that will affect the retail lenders or borrowers, I should say, or it will impact on the investors that invest in banks, remembering that about 60% of our stock market is made up of financial institutions, and about 60% of super funds invest in the banking sector as well. So a lot of investment will be potentially affected by this, either directly through a higher interest rate or a higher fee, or indirectly through a lower dividend.
Yeah, I think you're right, and there'll be a lot of lobbying going on. If anybody listened to the radio this morning or after the budget last night, there was a fair bit of discussion, let's say, from the banking sector about how unhappy they were about the proposed levy. So I expect from Joe Public on the streets probably not going to worry about it too much, unless he thinks about the things that Brett's just talked about. But as far as it just sort of goes in line with the bank bashing that's going on. It's a political issue, like looking at the mining sector in years gone by.
Yeah,
it's now looking at the banks.
It's like a mining tax, isn't it?
Yes, that's
Except
right.
we might actually raise something from this one.
Possibly, that's right. Yes. Now, the next item there is in relation to a foreign workers levy. So there's from March next year, I think it is, businesses that employ foreign workers on certain skilled visas are going to be required to pay a levy that'll provide revenue to what's being called a Skilling Australians Fund. And it will require businesses that have a turnover of less than $10 million a year to make an upfront payment of $1,200 per visa per year for each employee that's on what they call a temporary skill shortage visa, and a one-off payment of $3,000 where the employee is being sponsored by a permanent type visa, so a subclass 186 or 187 type visa. Businesses that have a turnover of more than $10 million have higher fees, so $1,800 for the temporary skill shortage visa and $5,000 for the others. So that Skilling Australians Fund is essentially going to be established to prioritise the training of apprentices and Australians generally, but essentially apprentices and traineeships for occupations that are in high demand in Australia, where we do rely on skilled migration to undertake those roles. Now, the fund is proposed to, I think, be the funding to be matched by the states and to support, they're saying about 300,000 apprentices and trainees over the next 4 years. There will be an eligibility criteria for the fund that's going to be defined by the Commonwealth, with the state's access to the fund being conditional upon their agreeing to meet certain conditions. So there's a bit of discussion, I guess, that needs to take place between the Commonwealth and the states to see how the machinations of that are actually going to work.
I actually learned something last night, Kim. I didn't realise that roll your own tobacco and cigars were taxed differently than manufactured cigarettes.
There you go.
But now going forward, they won't be. They'll actually be the same.
They will be.
So there you go. Learned something last night. So obviously, the price of the tobacco in a satchel or cigars will increase because they're matching the tax rate for the manufactured cigarettes.
Business tax rate changes is another area that we've heard a fair bit about in recent times. So the government's 10-year enterprise tax plan is still going ahead. Legislation has been introduced and passed to change the tax rates for the next 3 years. So for the 16-17 year, the corporate tax rate for small business is going to reduce to 27.5%. And that will relate to small businesses that have been newly defined as with a turnover of less than $10 million. That turnover threshold increases to $25 million in the 17-18 year and to $50 million in the 18-19 year. So 27.5% tax rate, you need to make sure that you are carrying on a business in that entity. And the small business definition does look at aggregated turnover, so it will look at the group as a whole, not just the entity in isolation. So something to keep in mind when you're looking at whether those tax rates will apply. There'll also be an increase in the unincorporated small business tax discount from 5% to 16% over the 10-year period, and the threshold for accessing the discount is going to be, I think, $5 million. Again, on an aggregated turnover basis. And the last point here on the other measures is really just in relation to some crowdsourcing or crowdsourced funding. Crowdsourced funding measures were introduced last year, where the equity funding was available under these new rules for public companies, but these crowdsourced equity funding rules are going to be extended to proprietary companies. So it essentially gives a wider range of businesses access to additional sources of capital. Those proprietary companies will be able to have an unlimited number of these types of shareholders. Going along with that, though, there will be higher governance and reporting obligations placed on those entities. So minimum of 2 directors, there'll be financial reporting to be done in accordance with accounting standards. So special purpose accounts may not cut it in some circumstances. There'll be audit requirements that are imposed as well, restrictions on certain related party transactions, and certain shareholder rights to participate in exit events and the like. So where it's the entity's gobbled up by a larger organisation along the way. So it's a positive move, but there will be some, those governance issues around it will need to be managed along the way.
Another infographic for you. This essentially, there was a lot of talk last night around the infrastructure spending that is being proposed. Now, need to put that into a little bit of context. Some of this does stretch out to over 10 years. So the interesting thing, I suppose, for us here in Brisbane is that there's no mention about the Cross River Rail Tunnel. However, they are talking about building a train network or train line from Melbourne through to Brisbane, which will actually cut through, proposed it'll go through a tunnel through at Toowoomba. So that'll be rather interesting to see how that all plays out.
Yeah, so it seems like there's a lot going on. Really.
Yeah, there does, and particularly in New South Wales, which I suppose the bulk of Australia's population are there, so that does make some sense.
Yeah, that's true. Okay, so no budget would be complete without some tax integrity measures that come along with it, and some of those measures include the multinational anti-avoidance laws that are being expanded. So these laws are being amended to negate the use of foreign trusts and partnerships in corporate structures where they've been used to circumvent the law along the way. So the amendments are going to apply retrospectively, so from the 1st of January 2016 when these anti-avoidance laws were introduced. And I guess just something to be aware of. I'm a believer in the trickle-down effect. Whatever hits the big end of town eventually trickles down to the small end of town. So just more keeping an eye on and being aware that with more and more international expansion being done by all businesses, that some of these laws and rules that are being put in place will provide data for other sectors along the way. The government is also going to continue their black economy crackdown. So there's an additional $32 million being introduced to provide the tax office with the ability to provide more audit and compliance programs to target the black economy.
With the superannuation integrity measures, Kim, on the limited recourse borrowing arrangements, we actually saw some draft legislation around this a couple of weeks ago. And really what they're looking to do is, if a super fund undertakes a borrowing arrangement where the member is either in pension phase or is looking to make further contributions, it potentially is going to impact on what their strategy may be, because the loan value, essentially what they're doing is, instead of taking a net value from a member's account point of view, they're taking a gross. So they're bringing the loan into the $1.6 million caps that apply. So for argument's sake, if someone obtains a loan to then buy a property, they may be then prohibited from making further non-concessional contributions into super. Now, this measure is meant to commence from 1 July or the beginning of the quarter after the passing of the legislation. So it hasn't actually been introduced into Parliament yet. It's meant to happen during this winter sitting.
Okay. There has been a system around in the last couple of years called the Taxable Payments Reporting System, TPRS, that has related to mainly the building sector, building and construction, where reporting is made to the tax office so that it can ensure that the tax obligations of the contractors in that industry are actually being satisfied. That reporting is going to be extended to the courier and cleaning industries. So the system only covers, like I said, building and construction services to a purchaser who's carrying on a business primarily in the building and construction industry at the moment. But those, like I said, that reporting is going to impact on other industries, and I guess the tax office and the government is targeting the areas where they're seeing a bit of lack of reporting or lack of lodgement of returns and remittance of tax. So this is a way for them to make sure that they actually know who to chase and make sure that they can follow up the payments along the way. Now, GST and new residential premises, this was an interesting one that where essentially what this announcement is the purchases of newly constructed residential premises or new subdivisions are going to be required to remit the GST in respect of that property directly to the tax office as part of settlement. So normally we don't know what the amount of the GST is that's included in a a property that we've acquired, because that's the seller's obligation, and so the developer goes and remits that. However, the tax office has obviously experienced circumstances where developers are failing to remit the GST, despite having claimed the credits along the way for their construction costs. And as a result, this measure, this integrity measure, is basically along similar lines, I guess, to the CGT withholding rules, that they're saying, well, at settlement, we want to make sure that the GST is remitted. So it'll require the contracts to actually disclose what the GST amount is, and a mechanism by which the purchaser can actually remit that GST to the tax office. Again, might be on a similar basis to what the CGT withholding rules apply. So an interesting one that places more onus on the purchaser. That is proposed to start on the 1st of July next year.
So we're all going to become tax collectors, essentially.
We are, that's right, exactly. Yes.
And another integrity measure that relates to superannuation is essentially, it appears that they're trying to codify tax office rulings that have been introduced in the last few years in relation to related party transactions or borrowings from related parties. What looks like they're actually going to be putting it into the legislation to require the transaction to be on a commercial foot. The tax office have got guidelines and requirements as to what that looks like. But clearly, the Treasury think that that's not strong enough, and they actually want to now put it into legislation. So that'll be very interesting to see how that plays out.
Okay, well, that's pretty much a wrap up of everything that we gleaned out of last night's budget from a tax and superannuation perspective. It wasn't there wasn't anything groundbreaking in it, really. It was just more of I think a budget by a coalition government that looked very much like a Labor government budget, I think. So politically, they should be able to get these measures passed, which has always been a challenge in the past. And although there might be some tweaking around the edges from the opposition, just to mould it into a bit more like what they would prefer, then I think we might actually have these measures enacted in the next few months. So
as opposed to waiting 3 years for the 2014 budget to go through.
Exactly right. Yes. So thanks everybody for attending. Now the federal budget report is on our website. So if you received the email, then you can click on the link to download the report. Otherwise, these slides will have a link to the report. It's on our website, on the front page of our website as well. And
just before we sign off, Kim, we've got one question there from Julie in relation to the 10-year holding of the residential property in relation to the downsizing provisions that were announced with the superannuation measures. While we don't have any detail in that, I would presume that you would actually need to hold, it would need to be your principal place of residence for that 10-year period to enable you to then claim that contribution, or allow you to put that contribution into super.
Okay.
So Julie's question is, does it have to be your principal place of residence for that period of time, or could it have been an investment property and then say you move into it, becomes your principal place of residence, then you downsize? I would think that they've got a time frame in there, so my presumption is there would have to be your PPR for that 10 years. Otherwise, then people would manufacture a result by having investment property, moving into it for a period of time, and then selling it to downsize.
Okay, all right, good to know. Okay, thank you everybody for attending. If you've got any questions along the way following the session, then feel free to drop us both an email, and we'll see if we can help out.
Thanks
very much. Have a great day.
Cheers.